evening, everyone. CFA Society is pleased to present the Professional Investor's Guide to Bitcoin, Blockchain, and Cryptocurrency. This evening is in keeping with our strategic objective of providing member and candidate value and providing support in being the most trusted and respected in their respective fields. We aim for 100% member satisfaction. We're particularly excited to have been able to extend invitation to CFA Society Cayman, CFA Society Barbados, and CFA Society Bahamas. We welcome you all to this webinar and we look forward to your contribution. Before we get started, I would like to mention some housekeeping practices that will maintain the quality of today's experience. Firstly, we would like to note that the webinar is being recorded and will be posted on CFA Society Jamaica's YouTube channel and as well as our society's website. We ask for all participants to keep their mics muted until we get to the Q&A section and to only unmute if you're acknowledged within that section. Please place your question in the chat during the presentation and also during the Q&A session. We will be asking 2 survey questions during this agenda, so we kindly ask for your participation. We thought this webinar timely given recent growth and renewed buzz around cryptocurrencies. We have seen the number of cryptocurrencies trading globally doubling since 2019, now reaching 4,000 cryptocurrencies, with Bitcoin being the most popular. Now, if you didn't know, the value of the Bitcoin now stands at $1 trillion and represent the largest currency, the 5th largest currency, surpassing the Indian rupee and the British pound. To put this in context, the value of the US dollar is $2 trillion. And putting this even closer to home, BOJ recently announced that they're moving forward with a central bank digital currency. We are excited to have today as our presenter, Matt Hougan, who will be going into greater details in what I would have just said. Matt is the Chief Investment Officer for Bitwise Asset Management, creator of the world's first cryptocurrency index fund. Hougan was previously CEO of ETF.com, where he helped create the first institutional ETF classification and rating system. His thoughts on investing has been widely profiled in the media, including Bloomberg, Wall Street Journal, New York Times, Financial Times, and this is just a few of them. A cryptocurrency columnist for Forbes, Matt has been featured on Bloomberg's Masters of Business. Matt, I don't think you need any more introduction than what I just gave to you. And you're certainly capable to talk to us and to answer any questions that we have about the topic that you're going to present on. So Matt, I'll now give it over to you.
Oh, thank you so much, Carrie Ann. Thank you to everyone from CFA Jamaica and the other chapters for having me here today. I wish we were in person, but it's great to get the chance to spend some time with you to talk about crypto and crypto assets. I know I may have more gray hair and no hoodie from what you would expect for someone who is a cryptocurrency asset manager. But I'm going to try to break down everything I know about this space. I would emphasize what was mentioned about asking questions. I'm going to talk for about 45 minutes about what crypto is, what it does, why it's interesting, what the risks are, where it's going. But the way this will be a phenomenal event, as opposed to just an okay event, is if you all ask the questions that are deep-seated in your mind. And you don't have to be polite. I know some of you out there are probably thinking, Matt, I've heard this is a tulip bubble and Bitcoin is worth 0. Well, ask me that question. Or Matt, won't governments ban Bitcoin because they want to launch their own central bank digital currencies like the BOJ has talked about doing? Ask me those hard questions, write them down as I go through my presentation, and we'll get to as many, and I'm happy to stay as long as you want to talk about crypto. But let's get started. This is what we're going to talk about today. I'm going to assume that the people on this call have a wide variety of knowledge of crypto. So I'm going to give you 1 minute about who is Bitwise, and then going to dig into what crypto is, why it matters, why is there more than one crypto asset, and how many crypto assets do we need? How does it fit in a portfolio? And what inning are we in terms of crypto's development? These talking points are gathered from the research brief that my colleague David and I recently published for the CFA Institute's Research Foundation, which is available on their website to download. A 64-page introduction to crypto. And hopefully at the end, you'll have a better view, a better ability to talk about crypto and blockchain with your peers. But let's dig right into it. Just so you know who Bitwise is, this is not a commercial, but Bitwise, as mentioned, is one of the largest crypto asset managers in the world. We manage over $1 billion. We've been in the market for 4 years. We have the first and largest cryptocurrency index fund in the world. Some people call it the S&P 500 or FTSE 100 of crypto. And we're well known in the market for doing what we're doing today, which is while we provide products to the market, we're really all about education. We want people to understand this asset class because we think it's interesting. We think they're real risks, but they're real opportunities. And so we spend most of our time educating. And if people come into our funds, that's great. Obviously, we're a US focused asset manager, so I don't have to worry about the commercials here. Let me skip through the about us. There's a picture of our guide to crypto assets, which you can download. And let's get into the fun part. Okay, what is crypto? If you come from a traditional financial background, you've probably met a lot of people who are very skeptical of crypto. They don't think it's worth anything. They don't understand what it is. They don't know what a blockchain is. They don't know why it might be valuable. I'm going to try to break down how I talk about crypto and why I think it's interesting. So first, let's start with this slide. There are a lot of people who are very skeptical about Bitcoin and other cryptocurrencies because of the name cryptocurrency. Because it's called a cryptocurrency, they expect to use Bitcoin and other crypto assets in the same way that we use the dollar here in the US. They expect to go to their local coffee shop and buy their morning coffee with Bitcoin in the same way that they go and buy their morning coffee today with dollars. And the thing about Bitcoin is if you contextualize it in this way, if you're expecting to use it in the same way that you use traditional currencies, you're going to be skeptical and you're going to be disappointed because none of us are going to the market and paying for our groceries in Bitcoin. None of us are getting paid our salaries in Bitcoin. I haven't used Bitcoin to buy coffee except as sort of a joke. And I would argue that it will be a long time and possibly never before we are using Bitcoin to buy our mocha frappuccino at Starbucks. This is not what Bitcoin is about. This is not why it's interesting. The right way to contextualize what Bitcoin and blockchain is about is to forget the term cryptocurrency and instead think of crypto as a technology that moves money into the internet era. And here's what I mean. This chart, I'm going to show you this a couple of times because I think if you understand what I mean by accepting crypto as a technology and not as a currency, you can really understand the risks and opportunities that attend this space. So this is my first attempt. If I were to send you guys a check for $10,000, I'd go and I'd write a check and I'd deposit it in my mailbox and send it to Jamaica. You guys would receive it. You deposit it at your bank maybe. And a handful of days later, 5 or 6 days later, the check would clear and you'd be able to withdraw your money. The reason you can't withdraw money instantly if I send you a check is that your bank where you deposit my check can't look into my bank's database and make sure that my check is good. It doesn't know that I have money in my bank account. It doesn't know that it's not overdrawn. It doesn't know that I haven't written multiple checks on the same account. And as a result, it takes multiple days for checks to clear. In the US, if I send money to a friend in New York, it'll take 5 days for the check to get there. They'll deposit it at their bank. It'll take another 2 to 4 business days before they can withdraw their money. One way to contextualize what crypto is, one reason why BOJ and others are looking at central bank digital currencies is because it allows money to move in an internet fashion. It allows me to send money and other items of financial value to someone else in the same way that I might send an email or a text. Now, certainly in the US, and I'm sure in Jamaica and other markets, I know what people typically respond to that, which is we already have apps on our phone that let us do that. So in the US, a lot of us use Venmo. Globally, a lot of people use PayPal. We have apps on our phone that allow us to send small amounts of money to our friends, to babysitters, to tip people. And we use them all the time. In fact, Venmo is one of the most installed apps in the United States. I think there are over 200 million Americans running around with Venmo on their phone. And Venmo exists because it's fast. If I send you $20 on Venmo, you get it instantaneously. Compared to if I write you a check, you can withdraw your money 5 days later. The key to understanding everything that crypto is, everything that blockchain is, everything that CBDCs, central bank digital currencies represent, is understanding why Venmo exists. And here's what I mean. The reason we can send money quickly inside an app like Venmo or PayPal is that within that app, we can only send money to someone else using that app. In other words, Venmo is a closed garden. It's a singular database. So if I want to send if I want to send my friend Dave $100 inside Venmo, Venmo can look at my account. It knows that I have $100. It controls every transaction. So it knows I haven't already sent that $100 to someone else. And it knows that David is a customer as well. And so it can transfer that money as quickly as you or I can change one line in an Excel spreadsheet, right? Check that I have it, transfer it to Dave. It takes about a minute. By comparison, banks are slow because there are 1,000 different databases. My bank here in the US doesn't have a direct relationship with, say, Dave's bank in New York. And so if I write a check from my bank account and Dave deposits it at his bank account, his bank won't let him have the money until it looks back and agrees with my bank that I'm good for it, that I haven't overdrawn my account, I haven't written multiple checks on the same account, etc. That process of checking, trust, and verification is why money is one of the slowest moving things in today's society. In other words, one database allows money to move quickly. Multiple databases, because they require trust, allows money to move extraordinarily slowly. And the whole key, the reason blockchain is interesting, the reason crypto is interesting, the reason the Bitcoin blockchain is interesting, actually has nothing to do with being this new novel global internet currency. What it has to do with it was solving, the Bitcoin blockchain solved a decades-old computer science problem by creating the world's first database that's available everywhere, that everyone can see, but with no single party controls. In other words, the Bitcoin blockchain and all subsequent blockchains that exist were a new database architecture that allowed one database to exist everywhere in the world, which everyone can see, everyone can agree on the state of, but which no single party controls. So while Venmo was one database controlled by a single company, and you have to trust that company not to run away with your money, it has limitations in terms of how much money it can hold. Not everyone can use it equally. It can discriminate against people or censor payments. Blockchains are the first database that have ever existed that are available everywhere in the world, which everyone can see on an equal basis, but which no single party controls. And that aspect, no single party controlling it, is this enormous technological breakthrough. Now, let me explain why. Why does it matter to have one database that's available everywhere, but no single party controls it? The reason it matters is it does three things that we've never been able to do before in the world. It introduces three new, what's called primitives, three new capabilities in technology that we've never had before. The first is an exponential increase in settlement speed. And let me make this very real, very tangible. If I were to go to Bank of America, one of the largest banks in the US, if I were to go to their international wire page right now and say I wanted to send $10,000 to Carrie Ann in Jamaica, what the international wire page would tell me is that it takes 2 business days and the fee is 1% to 4%. In other words, if I want to get $10,000 abroad to somebody in another country, the fastest it can get there is on Monday, and the fee is 1% to 4%. By contrast, the other day on the Bitcoin blockchain, someone sent $1.1 billion in a single transaction. They sent it at night outside of banking hours, and it settled in 10 minutes, and the fee was 57 cents. So on the one hand, you have one of the largest banks in the world. Bank of America has 240,000 employees. It has offices in 38 countries. It has a high-paid CEO. It has an enormous tech team. And the fastest they can get money abroad is by Monday, and the fee is 1% to 4%. By contrast, the Bitcoin blockchain is an unmanaged network with no employees, no offices, no CEO, no paid tech team, no balance sheet of its own. And it can move $1.1 billion in 10 minutes for a fee of 57 cents. The reason it can move that money so quickly is because it's this database that's available everywhere, which everyone can see, but no single party can control. So it can move money globally to anyone as fast as PayPal or Venmo can move money within their closed ecosystem. And while money is just one thing, it can do this with any financial good. One of the weird things about existing in today's society is while we can have this conference call that connects me here in Berkeley, California, with the CFA chapters in Jamaica, Barbados, and other folks all the way or halfway around the world, financial goods move at just glacial speeds. We accept it, but in the US, stocks settle in 2 days. If I go to my bank account and pay my internet bill or pay my mortgage, it takes 5 days to hit my account. Money is actually one of the slowest moving items in today's society. And what blockchain is about, what Bitcoin is about, what crypto assets is about, is allowing that money to move at internet speeds. Just remember that example of Bank of America taking 3 or 4 days to move $10,000 abroad, and the Bitcoin blockchain, despite having no employees, moving $1 billion in 10 minutes for a fee of 57 cents. It allows an exponential increase in settlement speed because of that new database architecture. But here's the thing. That's actually maybe the least interesting thing that crypto and blockchain does. The next thing that it does is once you have money that can exist on the internet, that can move at internet speeds, that's internet native, you can actually program it like software. And one of the curious things about the financial industry is while software and automation have disrupted huge chunks of the global economy, the financial industry has been more or less left alone. If you think about a service that the financial industry provides, like an escrow agent, all an escrow agent does is sit in the middle of a transaction. Let's say we're buying a house. If you're buying a house, at least in the US, you hire an escrow agent, you give the escrow agent your down payment, the bank that you have a mortgage from gives them the rest of the money, the owner of the house uploads the deed to that house, and the escrow agent crosses that transaction. And for that, they charge a fee, $500, $1,000, $2,000. Well, if you think about that, all that is an if-then statement. If Matt uploads the money to buy this house and John uploads the title to this house, cross the transaction. Well, guess what? Once you have money that's native to the internet, you can replace that escrow agent with a software program that will handle that escrow in a perfect fashion for a fraction of the fee. And it's not just escrow agents. Actually, crypto is being used to disrupt the traditional financial system right now in a number of fascinating ways. It's an area of the market called decentralized finance or programmable money or self-driving banks. But many of the services that the traditional financial industry has historically provided can be programmed into software once you put money into the internet, once money exists in an internet native fashion. And right now there are software protocols, crypto protocols, processing hundreds of millions of dollars of loans in a software algorithmic fashion, doing hundreds of millions of dollars, hundreds of billions of dollars of trading activity without any market makers involved, just using crypto-enabled blockchains. Essentially, many financial services can be replicated by software once you put money into the internet. And here's the thing. These two ideas alone, right? Programmable money and rapid settlement of financial goods are big ideas, but they're actually not even the biggest idea that's embedded in crypto and blockchain. Once you have one database that's available everywhere in the world that everyone agrees is true, but which no third party controls, you actually create digital property rights and digital scarcity for the first time in human history. So if you think about it this way, one thing about the digital world is it's all represented with letters and numbers. So if you have a bank account, that bank account is just a string of letters and numbers, and there's a bank that identifies that you are the holder of that bank account. And you need that bank to verify it because anyone could copy and paste those numbers and create an infinite number of copies. One of the things about crypto and blockchain is once you have one database that's available everywhere and everyone agrees is true, but there's no third party that guarantees it, you can own something in a digital sense, the same way that I own this book or the cell phone, or maybe a Picasso on my wall. You can own a digital good without any third party blessing you, and you can prove to the world that you own it. So it creates property rights for the first time ever. Many of you probably saw that Christie's recently held an art auction, and someone paid $69 million for a digital piece of art, effectively a JPEG. You may have also heard of things like Sorare or NBA Top Shots, where people are paying hundreds of thousands of dollars to own a clip, a video clip from the NBA. People are selling things like tweets. All of these things are probably silly. Should someone pay $69 million for a JPEG that anyone else can see? Should someone pay hundreds of thousands of dollars for a clip from the NBA that you can watch for free on YouTube? I don't know. I'm not here to tell you that. But here's what's interesting about it. The entire reason this exists, the reason we're getting digital baseball cards for the first time ever, the reason people are talking about digital art for the first time ever, the reason you're hearing about NFTs for the first time ever, is that blockchains enable you to have digital property rights for the first time in human history. And so we get a lot of questions at Bitwise about crypto's performance. And crypto's performance has been phenomenal, right? It is the best performing asset class in the world this year. This chart looks at the returns of the Bitwise 10 large cap crypto index. That's a diversified index of crypto assets. The returns of Bitcoin, those are the two lines at the top. And then the returns of major financial assets like the S&P 500, international stocks, emerging market equities, oil, gold. Those are the lines at the bottom. And crypto has been the best performing asset class in the world this year. It's up about 100% on a year-to-date basis. It was the best performing asset class in the world last year. It was up about 300%. It was the best performing asset class in 2019 as well. It was up about 90%. It's been the best performing asset class since 2017. It's up about 4,000%. It's also been incredibly resilient, unlike many sort of famous financial bubbles like the tulip bubble, which went up in Amsterdam and then crashed back down. Bitcoin and crypto has gone through a series of up and downs. In fact, since its inception in 2010, when it first started trading, Bitcoin is up 43 million%. But it's gone through a number, I apologize, I'm having a little computer difficulties. It's gone through a huge number of pullbacks. If you look at this chart, two things should stand out to you. One, it's been a phenomenal return, up 43 million%. But two, it's had 70% drawdowns. And yet it has always rebounded and returned to new all-time highs. And a lot of people ask me, how is that possible? Why is that happening? And the reason is that crypto and blockchain and Bitcoin is not about a new currency that emerged out of the sky. It's not about this fake internet money that someone dreamed up and now it's worth $1 trillion. What it is a generationally important technological breakthrough that allows us to use the internet in new ways. Now, I'm older than many people on this call, I'm sure. I'm 44 years old. But I remember back to the days when the internet was terrible. And maybe some of you remember that as well. When I was growing up, you couldn't use the internet for much. In fact, all you could use it for is to send files to people. We actually had a word for it. We called it FTPing. That stood for File Transfer Protocol. And that's how you told the internet you wanted to send someone a file. And we thought it was really cool. It was cool to be able to send files to people over the internet. Over the years, people have figured out new things to do with the internet. So as an example, in 1982, people figured out how to send text over the internet using something called the Simple Mail Transmission Protocol. That is actually what allowed email to exist. It gave birth to AOL and CompuServe. And today we all use email and postal services have been disrupted. In 1989, someone figured out how to send linked text over the internet in something called the Hypertext Transfer Protocol. I'm sure you all have entered a website where you put HTTP at the beginning. That's the way of telling the internet to interpret this as linked text and to open a particular website. That breakthrough allowed us to create the World Wide Web, disrupted all of traditional reporting, disrupted all of media, disrupted all of advertising. It was a major breakthrough. In 1994, we figured out how to put encoded text in the internet. Many of you might remember, I remember being warned as a kid never to put your credit card information into the internet. The reason those warnings existed is that prior to 1994, anything that was streaming through the internet was streaming in real text. In other words, if you put your credit card information into the internet, anyone looking at the data pipes could see it exactly as it was. In 1994, with something called SSL, we figured out how to put encoded text in the internet. And guess what happened in July of 1994? Jeff Bezos created Amazon and disrupted all of retailing. Before 1994, you couldn't have internet commerce because we didn't know how to do something in the internet. We didn't know how to encode text. We figured that out in 1994, and it disrupted all of modern retailing. We've had other disruptions as well. In 1995, we figured out how to send voice over the internet. In 2009, we figured out how to do video over the internet. And now we're all on Zoom, probably on our 10th Zoom call of the day. I'm talking to you from Berkeley, California, and hopefully it's coming through clearly. The right way to think about Bitcoin and crypto and blockchain is it's the first time we figured out how to move money and other financial goods over the internet. Before Bitcoin and blockchain, money moved through our traditional financial system. But what crypto and blockchain enabled us to do by creating one database that's available everywhere, but which no single party controls, is to move money and other financial goods through the internet. That enables us to program money, enables us to have digital property rights, and it's a generational technological breakthrough. So why is crypto up 43 million %? Why has it been resilient over the years? Because this is an important technological breakthrough. It's the reason the BOJ is talking about central bank digital currencies. This is the future of how financial goods will move in the modern world. And I'm sure we'll talk about that more at the end of the presentation. Now, I want to pause there. That's my core introduction to crypto, and talk a little bit about this, which is a very important question, which is, why is there more than one crypto asset? You know, Carrie Ann mentioned there are 4,000, 5,000, 6,000, 7,000 crypto assets out there. It seems new ones are created every day. Why do we need more than one? And the way to answer this question is to understand that every blockchain is its own software solution. So a lot of us have thought about software investing, right? Many people invest in the software industry. Microsoft is a great company in the software industry. Oracle is a great company in the software industry. Slack is a great company in the software industry. Salesforce is a great company in the software industry. No one asks why we need more than one software company. We accept that we need them because Microsoft does something different than Oracle, does something different than Slack, does something different than Salesforce. They're all good at different things. If you want to blow the mind of people you talk to when you're talking to them about crypto, the same thing is true of different crypto assets. The reason there are 4,000, 5,000, 6,000 different crypto assets is that they're all optimized to do the same, to do slightly different things. So here I've put the logos of 4 of the largest crypto assets. Bitcoin, which I'm sure you've heard of. The triangle diamond shape on the right is Ethereum's logo. That's the second largest crypto asset. The ones on the bottom, Chainlink and Uniswap, are other examples. The right way to understand these is to understand these just like you understand software companies. So the Bitcoin blockchain is optimized to do different things than the Ethereum blockchain. Let me break that down so you understand what I mean. Bitcoin was the first blockchain technology. It's actually a very simple software. If those of you who are coders, the actual core code of the Bitcoin blockchain when it was originally released was only about 350 lines long. It's a very short code base. And the thing about Bitcoin is it actually can't do much. As a software program, it's very simple. All you can program Bitcoin to do is to send Bitcoin, receive Bitcoin, hold Bitcoin, destroy Bitcoin, do some very simple escrow style payment transactions. It's very limited. It's more like a calculator than it is like a computer. Ethereum was the second major crypto asset developed that really emerged and gained a following. It was developed in response to Bitcoin. And what separates the Ethereum blockchain from the Bitcoin blockchain is that you can program the Ethereum blockchain to do anything. You can program it to serve as a lending agent. You can program it to serve as the basis for raising capital. You can program it to fill the role of an insurance company. You can program the Ethereum blockchain to do anything you can program a computer to do. It's called a Turing complete blockchain. You can make it do anything. Now you might be thinking, Matt, doing everything is better than doing a few things. But that's not necessarily true. In the world of cybersecurity, doing a very few things, having a limited code base, means your database is more secure. So the Bitcoin blockchain is unlikely to have bugs. For 12 years now, it's been holding significant assets. It holds $1 trillion of assets today. It's never been hacked. It doesn't change much. It's optimized to be a really secure way to hold money and move it around the world. The Ethereum blockchain is optimized to do lots more interesting things. It updates more frequently. It's more ambitious. It can be programmed in different ways. And for that reason, it's finding real use. It's never going to be as secure as Bitcoin, and Bitcoin is never going to be as useful as Ethereum. And if you get into the crypto ecosystem, you know that people talk about Bitcoin as digital gold. The reason they talk about Bitcoin as digital gold is because it's exceptionally well designed for that use case. It's designed to be an extremely secure way to hold wealth, and that's basically it. People don't talk about Ethereum as digital gold because it's not as secure as Bitcoin, but they talk about it as the foundation of this new decentralized finance market because it can be programmed to do anything. And as you go down the chain toward each particular asset, they're all optimized to do slightly different things. There are crypto assets that are much faster than Bitcoin. There are crypto assets that are easier to program than Ethereum. There are crypto assets with different governance features. There are crypto assets like Uniswap that try to only do one thing, but do it very well. So the reason there are more than one crypto asset is the same reason there's more than one software company. Different assets do different things well. And I think in the future, there'll be a handful of these assets that are institutionally important and many assets that don't amount to much, just like is the case in the traditional software industry. Now, if you look at a slide like this looks at the return of the 10 largest crypto assets since November of last year. This is just a 4-month period. And if you look at the dispersion of returns amongst, again, the largest crypto assets over just 4 months, you can see that there's an asset in here that's up 1,000% and an asset that's up 40%. So almost 1,000% dispersion of returns in a 4-month period. It's phenomenal. Why does that happen? Because different crypto assets are good at different things and they're finding product market fit at different rates. The asset at the top is optimized to serve as a crypto lending platform, and it's growing exponentially. That's why it's up 1,000%. The same reason that a software company that finds product market fit will grow exponentially as well. The asset at the bottom was designed to compete with Ethereum, and it's doing a poor job. No one's building on it. Developer activity is low. No one is that interested. And as a result, its returns have been significantly lower. But this is a new sector of the economy, just like any other sector of the economy. There's lots of competition, and it's difficult to know which asset will win long term. If you had to ask me, I would say that Bitcoin probably has a lock on being a digital version of gold. It's probably dominating that market. But I don't know that that will be true for sure. There are other assets that will try to compete with Bitcoin, even in that market. The history of sort of disruptive new technologies is that the first mover doesn't always win. I had an AOL account. I remember having a BlackBerry and typing like this with my thumbs. We don't do that anymore, right? We all have iPhones or Google phones. It's not always the first asset to move that will win. So important to remember in the crypto market, there's more than one asset because they all do different things, and different ones will succeed at different rates in the future. All right, we're doing well on time. I want to talk a little bit about crypto in a portfolio, because whatever you think about crypto as an asset class, it's really interesting as an investment. And what do I mean by that? Crypto is unique among investments in that it combines 4 things that are really hard to find in any asset. Those 4 things are high potential returns. Now, crypto has historically had exceptional returns. As I mentioned, 10 of the last 12 years, it's been the best performing asset class in the world. That doesn't mean it will be the best performing asset class in the future. There are plenty of large, substantial risks which I know we will get to in the Q&A. But it does mean that it has the potential for high returns. The other thing it has is low correlations to other assets. Whether you look at stocks or bonds or gold or oil or volatility or junk bonds, whatever you want to look at, the correlation of crypto to those assets tends to be about 0.1 or 0.2. It tends to be 0.1 or 0.2 because the drivers of crypto are just different than the drivers of stocks and bonds, right? Stocks and bonds are driven by economic growth. They're driven by central bank policy. They're driven by interest rates. Crypto is driven by technological advancement, by adoption, by regulation, by the passage of time, by education, different drivers, so they have low correlations. But the thing about high returns and low correlations is usually when you're talking about that, you're talking about illiquid assets. You're talking about real estate. You're talking about private equity. You're talking about hedge funds. What makes crypto really unique is it offers those two unique characteristics of return, but it does so in assets that are liquid and accessible. So Bitcoin trades on an intraday basis. You can buy funds that offer daily liquidity. And importantly, retail investors can invest in exactly the same opportunities as the largest investors in the world. I know this because at Bitwise, we have endowments and hedge funds that are invested in our funds. And my father is invested in our funds. We have retail investors invested alongside some of the largest institutions in the world. And that makes crypto really unique. It makes it a unique alternative asset. And when you put it in a portfolio context, it historically has had a remarkable impact. So what this study is looking at, and this is detailed in our CFA paper, is what happens if you take a small allocation to Bitcoin or a small allocation to crypto, and you put it in a portfolio that's 60% stocks and 40% bonds, a classic portfolio, global stocks and global bonds. And what happens if you put it in at small amounts and rebalance it? And here's what you see. In this study, which ran from January 2017 to December 2020, adding even a 2.5% allocation to Bitcoin and rebalancing it on a quarterly basis boosted the total returns of that portfolio from 49% to 76%. And it did so, and here's the catch, without significantly increasing the volatility. And as a result, the Sharpe ratio jumped almost 50%. And the maximum drawdown stayed about the same. A lot of people assume because Bitcoin itself is volatile, because crypto itself is volatile, in a portfolio context, it will increase the volatility of your portfolio dramatically. But because it has that low correlation, and because it's liquid and you can rebalance, you can actually harvest some of that volatility. And at least historically, it's been able to increase returns without increasing the volatility of your portfolio. There's no guarantee that will be true in the future, of course, but that is what the historical track record shows. In fact, that last chart that I showed you looked at one point in time. It looked at a 4-year period from January 2017 to December of 2020. This chart is looking at the impact of Bitcoin on a 60-40 portfolio on a rolling 3-year return basis. So the right way to think about this chart and interpret it is that black line on the far left side of the chart represents the returns of a 60-40 portfolio for the 3 years ending January 1st, 2017. And the green shows what happens if you add a 2.5% allocation to Bitcoin. And then as you roll to the right of the chart, it looks at every 3-year period that was possible, such that the far most right point of the chart looks at the 3 years ending December 31st, 2020. And you can see that the core portfolio was up about 28%. And with Bitcoin added to it, it was up about 37%. The sort of TLDR, the short story here, is that there's never been a 3-year period in Bitcoin's history where adding it to a traditional portfolio hasn't increased your returns if you had a rebalancing tolerance in place. In fact, if you shrink that just to 2-year holding periods, the win rate is still well above 90%. So it's had a historical track record of having a uniquely positive impact on portfolios because it's combined those high potential returns, low correlations, and liquidity, which is a really unique set of things to put together in one asset. Again, there's plenty of risk out there. I'm not guaranteeing that this will happen in the future, but it is an interesting asset to consider from an alternative perspective with relatively low allocations. All right. I want to talk a little bit about where we are in the market right now, because I know some of you are thinking, Matt, this is great. You're telling me that an asset that's up 43 million% was a good investment. It's probably pretty obvious. Where are we and where does it go from here? And here's the thing about crypto. Crypto and Bitcoin is at this really unique point in its history, where it's going from something that traditional financial investors were afraid of to something that they're increasingly intrigued by. So if you look at these quotes from JP Morgan in 2017, JP Morgan CEO said Bitcoin was a fraud, worse than tulip bulbs, it won't end well, and someone is going to get killed. And in 2020, their flagship research report, the one they put their best analysts on, said the long-term potential for Bitcoin is significant, that it could compete intensely with gold as an alternative currency. And they later said that investors could have 1 to 10% of their portfolio allocated to Bitcoin. And that's been true. That evolution has been true across most Wall Street banks. At this point, nearly every major Wall Street bank is putting out regular research about Bitcoin and talking about it as an alternative asset, as a competitor to gold, as a new challenger to the traditional financial system. And it's not just Wall Street. Traditional asset managers are allocating to crypto as well. BlackRock, the world's largest asset manager, $7 trillion in assets under management. Its CIO recently said that Bitcoin could replace gold to a large extent and that crypto is here to stay. It's worth noting that gold is a $10 trillion market. Bitcoin is a $1 trillion market. If the world's largest asset manager thinks Bitcoin could replace gold, they're saying that the market for Bitcoin could grow 10x if it succeeds, and that crypto is here to stay. And guess what? BlackRock is now allocating to Bitcoin and crypto within its largest funds, within its global allocation fund, and a number of other funds as well. And it's not just Wall Street and asset managers. Insurance companies, some of the most conservative investors in the world, are now allocating to Bitcoin. Mass Mutual in the US, and I apologize for being US centric, that's where we're based. Mass Mutual recently invested $100 million in Bitcoin. These are the most conservative investors in the US. They're now allocating to crypto assets. Traditional S&P 500, traditional corporate equities are putting Bitcoin and other crypto assets on their balance sheet. Tesla famously bought $1.5 billion of Bitcoin in February. That's now worth maybe $2.5 or $3 billion. Square, MicroStrategy, others are allocating as well. Financial advisors, we do a survey of financial advisors every year, asking them if they're allocating to crypto in client accounts. That number has gone up from January 2020 to January of 2021 by 50%, from 6% to 9%. Now, this is a big survey. We surveyed over 1,000 advisors. 6% to 9% is a major increase. And the number who plan to allocate in the next 12 months is an additional 17%. And it's not just big sort of traditional financial advisors. Morgan Stanley recently said it became the first US bank to allow its wealthy clients to access Bitcoin. I bring all of this up to contextualize where crypto is in its journey as a disruptive technology. So many of you have probably seen this chart before. This is from a famous book, highly recommended, called Crossing the Chasm. And it was published in 1991. And it's about how new technologies move into the market. And what the author, whose name is Jeffrey Moore, talks about is that every new technology goes through two major phases. There's the early adopter market and the mainstream market. Now, I'm sure all of you have friends who love new technologies. They need the newest iPhone the minute it goes out. They're always talking to you about this new software program that they're using to optimize their productivity. They're always on the cutting edge. Nearly every technology finds some sort of early adopter market, but only a few technologies make the leap from that to the mainstream market. The mainstream market won't wrestle with technology that has issues. They won't accept flaws in the technology just because they think it's cool. They want it to work very well. If you think about the internet, for instance, in the early days of the internet, it was primarily used by the military and at university and by kids. And the rest of us looked at it askance, as something that would never amount to much. But we got Google and we got Netscape and we got email. and now the internet is available everywhere. It's part of the mainstream market. There are other technologies that never make this leap. Virtual reality is an example of a technology that's been stuck in the early adopter market for the last 30 years. We've been hearing virtual reality is just around the corner, and yet it never seems to get there because it can't penetrate the mainstream market. Another example is AI. AI also has been the next big thing for 20 or 30 years. And yet AI is only maybe now beginning to cross the chasm into the mainstream market. The right play to think about what Bitcoin and crypto is that, or where it is that much faster than anyone expected, it's crossing the chasm from the early adopter market to the mainstream market, much faster than anyone expected, including me. Traditional financial investors, mainstream institutional investors are embracing it as a new asset class. And the reason the price is up so much over the last few months, over the last year, is that these institutional investors are coming into the market and owning it. And the thing about this chart that really matters is that almost all of the market is on the mainstream side of the market. So I open this section by saying sort of what inning are we in crypto's evolution? I think we're in the earliest inning. We're in the inning where it just goes from sort of the preseason into the major leagues. Now I want to talk about questions, but I know one that's going to come up is central bank currencies. Given what the BOJ has been talking about, given how forward Jamaica is on central bank digital currencies. I'll start with this premise here. The reason I really love central bank digital currencies because it represents a reflection of reality, which is that blockchain technology is the way that all financial goods are going to move into the future. The reason central banks are looking at central bank digital currencies is because it allows money to exist in the internet era, be transferred more efficiently, be available to more people, bank the unbanked, open the market, allow for more innovation. It brings money out of the sort of analog age and puts it into the digital age. The difference between a central bank digital currency and something like Bitcoin is just whether or not you want one currency that's blessed by a government or one currency that's open architecture like the internet. And my guess is that both of these come to coexist in the future. But I think the important thing is that it reflects a realization that blockchain technology is what allows money to move in the internet era. So I'd close with this, and then happy to spend as much time as you guys want on questions. When you think about Bitcoin, when you think about crypto, when you think about blockchain, don't think of them as a new way to buy coffee. If you do, you'll be continually disappointed. What they are is a new way to move money over the internet. They introduce the idea of programmable money. They introduce the idea of digital property rights. They introduce the idea of speed of settlement for every financial good. The reason Bitcoin and crypto have gone up so much, the reason they've been so resilient, is that these are once in a generation ideas. This is an idea akin to moving commerce onto the internet, or voice onto the internet, or video onto the internet. And just as each of those steps disrupted major segments of our economy, moving money onto the internet is going to disrupt the traditional financial system in ways that we're just realizing now. Now, there are a huge amount of risks. I'm sure you're going to ask me about those. I love to dig into those, but it's been phenomenal to get to present this to you. And now I'm going to stop sharing my screen so I can see your beautiful faces during the Q&A. So thank you for listening.
Matt, thank you so much for that presentation. And I must say, I spent a few hours on the internet preparing for this webinar. And I don't think 80% of the information that you shared with us is available online. When it comes on to correlation, impact on portfolio management, I can tell it's not available online. Or YouTube, it's not there. So thank you so much for presenting that to us. And I'll just remind everybody here that this is being recorded. And if you weren't able to catch any a lot of what Matt said, if you joined late, you can feel free to look back at it, because this is a fairly new topic to the region and we might not be able to get everything in one go, albeit Matthew did a spectacular job.
Oh, thank you. Thank you.
I know everyone is eager to speak with you and to ask the questions. But before that begins, I have one survey question to ask, and I think now is the right time to do it. So this should just take about less than a minute. So I'm going to ask one of my able co-hosts to go ahead and launch it, and then we'll jump right into the Q&A section. Just reminding everyone, you can start putting your questions in the chat, and we will see it in the chat, and we'll ask you to just voice over for us, please. If you're not aligned with any of the societies that you're seeing in the poll, we're just asking you to select Friend of CFA Society Jamaica. Okay, I see Mary Kay, he said he joined late and he's asking where the recording will be available. So it will be available on our YouTube channel as well as the CFA Society Jamaica website. And on the website, you can also find all our past webinars, so feel free. All right, I think we're at 68 of 81. We're over a minute now, but I see persons are still answering, so we can just give them a few more seconds. Matt, I don't know if you're looking at the chat now, but you're getting a lot of big ups.
I love it. I love it. I appreciate it. Yeah, thank you. I am. They're making me smile. Thank you, everybody, for the nice comments.
All right, John, we're at 2 minutes now. I think you can go ahead and close the poll. So thanks, everyone, for taking the time out to answer. I know it's a break in the discussion, but this is information that is really helpful to the society to plan these events. All right, so we have some questions in the chat. The first is coming from Brian Fraser. For those of you who don't know, Brian is the president of CFA Society Jamaica. Brian, I'm going to put you on the spot now and ask you to just voice over your questions. I want to make this as interactive as possible. Brian? Yes, I'm putting you on the spot. All right, seems as if Brian doesn't want to be on the spot right now. So let me just, I'll do the first question for you.
Sorry.
Okay, go ahead. Okay, seems you have connectivity. All right, so let me take the first question, Brian.
Technology issues.
Okay, so Brian
the first question to Matt was the industry.
Right, so I'm not sure you heard him clearly, Matt. He's asking, what are the main threats to the crypto industry? And while you're answering that question, I think if you can just speak a little bit about cryptojacking, that would be good.
Yeah. What are the main traits for the crypto industry in general? Crypto industry is a really interesting industry. That's actually a phenomenal question. So one thing that's unique about crypto is that it emerged as sort of a retail renegade industry, right? It was mostly born from computer scientists and cypherpunks and libertarians who didn't like regulation.
Matt, I think you might be muted.
Yeah, I got muted there for a second. I was saying it started as this sort of retail anarchic industry, and it's moving into this truly institutional marketplace. And what I mean by that, in the early days, there weren't things that we would recognize in the traditional financial industry. Those services weren't provided by companies that we know. in the crypto industry. So as an example, custodying your crypto assets, right, where you store your crypto assets, used to be managed by companies that no one had ever heard of, that weren't regulated, that were started maybe by teenagers that did a bad job, and they lost a lot of crypto assets. Today, there's this institutional crypto marketplace. We custody our Bitcoin fund with Fidelity. We custody our other index fund with an $80 billion company. So it's becoming this very institutional marketplace. It's growing exceptionally quickly. There's a huge amount of venture capital investment. There's a huge amount of economic growth and hiring. And I think it's one of the fastest growing corners of the U.S. economy, and I think globally as well. So it's really an exciting market. When we're talking, I may have answered it wrong. Merrick's helpful to me. What are the biggest threats to the crypto industry? So thank you, Merrick. The biggest threat to crypto, I think, is still probably regulation. So crypto challenges traditional financial regulation in many ways. Crypto payments are pseudonymous, so they're not as easy to follow as traditional banking payments. Things like anti-money laundering and know your customer rules are harder to apply to the crypto ecosystem. And while much of crypto has evolved into a fairly well-regulated marketplace, there's still a lot of risk on how that regulation will evolve. And it's certainly the case that regulators in the US or elsewhere could crack down on crypto and constrain its growth. We've seen, for instance, in India recently, a movement to ban the ownership of crypto. So I think among the biggest threats to crypto are excessive regulation. The flip side to that is we need regulation in order for crypto to thrive. We wouldn't have institutional investors allocating if it wasn't increasingly well regulated. So it needs to be a balance, but regulation can get out of whack on either side.
Okay, so Matt, are we seeing countries moving towards putting in regulation for crypto?
Yes, 100%. You're seeing two things, sort of a two-track regulatory process, Carrie Ann. On the one hand, you're seeing companies punish the unregulated and negative aspects of crypto. You're seeing bad exchanges being shut down. You're seeing criminal prosecutions of fraud. And on the other end, you're seeing most countries establish a safe space around large cap crypto assets like Bitcoin and Ethereum and a few others to allow that market to thrive. And so you're seeing this two-tier process. But yes, most regulations, like the travel law that governs AML procedures around the world, is being applied to the crypto ecosystem, and it's moving into the regulatory light, which I think is a good thing for that market.
That's very promising, because as you said before, even for us as developing countries, one of the things that would probably prevent us from being more involved with cryptocurrency is limitations in regulations.
100%. That's certainly true, but I do think it's being embraced more and more, and that's true even in the US. The thing that prevented the crypto industry from really thriving in 2018 was a lack of regulatory clarity, and we're getting more regulatory clarity on a day-by-day basis. The last thing I'd add, and I'll use the US as an example, but this is true around the world, as new regulators come into the market, they're increasingly experienced in blockchain and experienced in crypto. So in the US, the new chairman of the SEC, the Securities and Commission, is an expert on blockchain and crypto. He used to teach a class at MIT. And I say that because it's happening worldwide, that people are moving into positions of power who have deep expertise in this space, because it's one of the most interesting parts of finance. And that means, I think, we're going to see better and sounder regulation in the future in the US and globally.
Great, thanks for that, Matt. The next question we have here, and I know this one is coming. Which is better, buying cryptocurrency directly or investing through an index or a stock? So I know you've done a lot of research and you're heavily involved in the ETF space and the indexing space. So this is right up your alley.
It is. I'm a big fan of indexing in general, and I'm a very big fan of it in crypto specifically. And I'll tell you why. It's really two reasons. On the one hand, on the one hand, it's a hard market to follow. There are new assets that emerge rapidly. There's a lot of technological disruption. And just like any emerging area, if you think back to the internet in the early days, or you think back to biotech, it's hard to figure out who's going to win. And one of the advantages of an index is it's always rebalanced to keep you exposed to the cryptocurrencies that are winning. The other thing I would say is it's very hard to pick and choose winners in this space. Even something like Bitcoin, which I think will be the digital store of value that my children will talk about in 15 years. I think it will succeed. Here are two ways that Bitcoin could fail. Bitcoin is very energy intensive. A lot of people are concerned about its carbon emissions. The second largest asset, Ethereum, is moving to a carbon neutral way to process transactions and secure the blockchain. Am I certain that Bitcoin will be digital gold and that people won't turn against it because of its carbon intensity and look for a more environmentally friendly alternative in the crypto space? I'm not certain. So do I want to have 100% of my assets in Bitcoin? I don't. I want to be distributed across the space because the bet I want to make is that crypto is more important in the future than it is today. And I don't want to be caught picking and choosing winners. It's like the bet I wanted to make on the internet was not that AOL was going to be the winner, but that the internet was going to be a big deal. And so why not just own that market? That's where all my money's invested in our index funds. So that's what I do.
Great. All right. So this next question is coming from Greg Samuels. How does the crypto industry guard against money laundering and terrorist financing? And I think this is an important question because especially for local banks that have intermediate relationship and maybe looking to offering Bitcoin, how do you see this panning out?
That's a wonderful question. And it's one that I thought about a lot, and I wouldn't be involved in the industry if I didn't think it could be well answered. The answer to it is the way Bitcoin works, to take that as an example, is you can actually trace every Bitcoin transaction that's ever happened in history. So you can follow it from this address to that address to that address to that address. The thing that you can't know is what that address is, who owns a particular account. So the way you do AML KYC in the Bitcoin ecosystem is that you regulate all the on-ramps. In other words, if I have dollars and I want to buy Bitcoin, I have to go through a crypto exchange or another on-ramp to get my dollars translated into Bitcoin. And so at that on-ramp, they're identifying people as they come into the crypto ecosystem. And once you do that, it's easy to follow the money and apply AML KYC rules. And so what you're seeing is a hardening of the on-ramps onto crypto, and then an acceptance that within there is more privacy in terms of micro movements than you would expect. But once you have that on-ramp, you can actually track people through the system exceptionally well. So for instance, the US Department of Justice has come out and said it's easier to track criminal activity on Bitcoin than it is in cash. Because of course, if you give someone cash, it's impossible to track. Now, there are cryptocurrencies that make that impossible. I think those currencies, which are called privacy coins, will be regulated out of existence. We don't invest in them. But the answer for Bitcoin is you harden the edges from an AML KYC perspective, and that provides the solution you're looking for.
Okay, thanks for that, Matt. All right, so the next question we have, I think this is a really good one. Because I mean, it compares to digital currency and to the central bank digital currency, which has backing of the dollar. So Hugh Miller is asking, how do you respond to Fed Chair Jerome Powell's remarks that cryptocurrencies are not really useful as a store of value because they are highly volatile?
Yeah, I would say they're not useful as a store of value because they go up too much. No, look, it's a great question, Hugh. The way I think about it is you have to think of, I think of it from a first principles perspective. So I asked myself a question: could a new store of value ever exist, or is gold the only non-sovereign store of value that will ever exist? In other words, could we ever have a digital store of value? And the answer to that question, I think, is yes. We have digital versions of virtually everything. So how would that come to be? It's actually too much, I think, to expect for a digital store of value to emerge into the world fully formed, to emerge in the world as something that's not volatile, if it's not backed by the dollar or backed by something else. You would imagine when it first started, it wouldn't be worth very much and be extremely volatile. And over time, it would become worth more as more people accepted it, and it would become less volatile. And eventually it would be as boring as gold. And what Bitcoin has done over the last 12 years, it started as not particularly valuable and extremely volatile. In the early years, it was common for Bitcoin to move in a price perspective by 50% a day. That was normal. And over time, it's become more valuable, right? It's gone from a penny to $50,000. And the volatility has come down to the point where it's like 4 times more volatile than gold now, not 50 times, but 4 times. And I suspect when my kids are older, it will be as boring as gold. So I think he's just getting ahead of himself. It's too much to expect for something new to emerge and be fully formed. It's going through a process of being an emerging store of value. And if it succeeds, it will eventually get to the point where it's boring. I'd add one last thing. In the US, there's a famous thing about gold, which is you can always buy a nice man's suit with an ounce of gold. Today, an ounce of gold is whatever, it's $1,800. That'll buy you a very nice man's suit. Years ago, it was maybe $30, $40, but you could buy a nice suit with that. The thing about that is you're never able to buy 2 suits. Stores of value aren't actually that interesting as an investment because they simply hold your value against other goods. The beauty of investing in an emerging store of value is that you have the chance for the value to go up. And so Bitcoin, I think of as properly considered an emerging store of value and not a fully formed store of value. And I think that's what Powell is getting after.
Okay. All right. So the next question. This one is a little long, so I'll read it slowly. Reading
I
from
love it.
All right. So with institutional adoption increasing exponentially, what are the projections for crypto in the short to medium term? For example, if big companies move 1% of their cash into Bitcoin, how would that affect the value of that currency?
Yeah, a great question. It would go up a lot. Here's the thing about Bitcoin that's different from other commodities. If people want more gold, gold mining companies increase their activity to pull more gold out of the ground. If people want more oil, oil extraction companies increase their activity to create more oil. If we want more copper, they do more mining of copper. If you want more Bitcoin, you can't get more Bitcoin. The supply is driven by software. The same amount of Bitcoin is created every day, regardless of how much demand there is. So if you think about like how to price Bitcoin, it's a supply and demand question. The supply is fixed. It's algorithmically known. I can tell you exactly how much Bitcoin there will be in the world tomorrow, a week from now, 2 years from now. So if new demand comes into the market, it'll move the price up substantially. How high? I don't know. One way to think of it, and I'm not saying it will get there by any means, and there's huge risks, and you shouldn't have most of your portfolio in crypto. But I go back to what BlackRock CIO Rick Rieder said, which is that Bitcoin could replace gold. Again, gold's a $10 trillion market. Bitcoin's a $1 trillion market. If Bitcoin replaced gold, if as much money was stored in Bitcoin as is stored in gold, it'd be worth $500,000 per Bitcoin. If as much money, if then Bitcoin penetrated other store of value markets like negative yielding rates or offshore wealth, it could be more than that. So I think that's like a order of magnitude upside. Now it's also possible that Bitcoin could fall 50, 60, 70%. That's just part and parcel of this asset class. It's the reason why even aggressive investors usually have single digit allocations. It's very volatile, but that's an idea. Could it be $500,000 per Bitcoin? It definitely could be if it comes to fulfill its role as a digital store of value in the market. I don't know if it will be. It would be great for me if it did, but I think it definitely is at least in the order of magnitude conceivable.
Thanks for that, Matt. So does that explanation hold true as well for having more ETFs within the market? Because we know that several are looking to get SEC approval and one was just launched in Canada.
Yeah, I was meeting with an SEC commissioner earlier today. So we're actively pursuing that as well. I think so. Look, one thing that I encourage you from that perspective, if you look at a historical chart of gold, the development of a gold ETF brought many new investors into the market. It happened to correspond or correlate with an increase in the price of gold. I don't know explicitly on and I don't even think on a day one basis will the launch of an ETF lead to an uptick in the price of Bitcoin. I don't know. But what I do think is that there are a lot of investors who would allocate to Bitcoin if it were easier that aren't allocating today. And one thing that a Bitcoin ETF would do is make it easier for investors to allocate to it. So yeah, there's an ETF in Canada, there's one in Europe, there's one in Switzerland. A number of people are working on it in the US. I think we'll get there eventually. And my guess is to be constructive for prices, but I think it'll play out over multiple years and not like a one-day event.
Well, we hope it's not a one-day event. All right, so Lester Messer is asking, what is your take about the future of the fiat currency and that's in comparison with cryptos?
Yeah, absolutely. I think central banks are going to move to digital currencies for two main reasons. One, it's more efficient, as we discussed. Money can move at internet speeds. Two, it also gives governments additional surveillance over financial activities, improves tax reporting, and those sorts of things. So I think that's an inevitability. The way I think about it in terms of what it means for crypto, if you think about what blockchains do as enabling money to exist on the internet, and you think about those three applications I talked about, they create exponentially increased settlement speed, they allow for programmable money, and they allow for digital property rights. Central bank digital currencies will never compete with digital gold. Like, it's just anathema. Digital gold has to be a non-sovereign store of value. That's the whole premise and idea. So will central bank digital currency compete with Bitcoin? Absolutely not. Will it compete with crypto assets that are trying to make money move faster around the world? Absolutely, right? Because a central bank digital currency that allows me to wire or move money to London in a minute is probably better than Bitcoin, which would move money in the same speed, but which would have price volatility baked in. And so then you have to look at every particular asset class of money on the internet and ask, is it better with a government sitting on top, or is it better open? And I think they'll all exist. So crypto will have a space, central bank digital currencies will have a space, but all of it will be based on blockchain technology.
Okay, so our next question comes from Althea Grant. Who ultimately owns cryptocurrency? She said, Bezos owns Amazon. Who owns crypto? With no third party having control, it suggests one primary owner. That is, who is ultimately earning the fees for all these crypto transactions?
Well, that's a couple different great questions. So thank you, Althea. Ownership is decentralized in the sense that a huge number of people own crypto. There's some millions of wallets that actively own crypto. I own crypto. I'm sure some people on this call own crypto. So it's widely held around the world. The question of who processes transactions, Bitcoin miners, I'm sure you've heard those terms. Bitcoin miners are just computers that are distributed around the world that process transaction and maintain the state of the database. If you think of what a bank does, it processes transactions and it maintains databases. Bitcoin miners do the same thing. It's just decentralized. Now, one thing that is worth noting, a lot of Bitcoin mining activity takes place in China. Not all of it, maybe not even most of it, but a lot of it. And that's something people talk about, is sort of the political risk of where mining activity takes place. But broadly speaking, it's decentralized. It's actually the largest supercomputing network in the world by a factor of like 400 or 1,000. It's a massive number of computers spread around the world, each of which is maintaining the database. And you can shut off one computer and there's still another 100,000 that are maintaining it. So it's decentralized in that sense. It's spread around the world.
Okay, well, I hope she's satisfied with that answer. All right, so Lydon Bromwell, my friend from NCB, he is asking, with the rise in developments of CBDCs globally, do you believe other countries may soon ban the use and ownership of cryptocurrencies like Bitcoin in support of their own digital currency?
That's a big question. That's a very live question today in the market. So the question is apropos. Ray Dalio, famous hedge fund manager in the US, just said he thinks the US government will ban Bitcoin at some point in the future. I think some countries will. We're already seeing India talking about banning crypto. I don't expect the US, which is the market I know best, to ban the ownership of Bitcoin. The US doesn't have a history of banning the ownership of financial instruments. In the 1930s, the US government seized all gold from US citizens, but they did it because the US was on a gold standard and they needed to engage in quantitative easing. And so they literally needed more physical gold. I don't think the US wants to stamp out the sort of economic growth that's taking place in crypto by banning Bitcoin. But down the road, is it a risk worth considering? Absolutely. Absolutely. It is a threat at some level to monetary sovereignty. And I suspect, I don't suspect that it will happen. But is there a zero chance that it will happen because they're concerned that it's competing with the SWIFT system or international payments, or that they'll constrain it in specific ways? I don't think there's a zero risk of that, but I don't think it's likely.
Okay, thanks for that. So VJ is asking, what's a good platform to buy or invest in cryptocurrencies, Binance or Coinbase? And I think a lot of persons, they're thinking this, but they don't want to ask it. I know I'm certainly thinking about it.
I love it. I love it. As a retail investor, Coinbase is a great solution. Kraken is a great solution. Binance is a more crypto native solution. I would feel open. In fact, I have a Coinbase account on my phone. So most of my money is invested in our crypto index funds, but Coinbase is a great place to start. I will say, here's the mistake you can make. Don't go with the cheapest crypto provider. Go with the best crypto provider. There's still a lot of risk in this ecosystem. It's still not regulated like the traditional financial system. So it pays to pay up a little bit for a better brand and a better solution. But Coinbase is a great example. PayPal is coming to market. Those are good places to start.
Okay, so before we move to the next question, I think you use a term Coinbase, and I don't think it spoke to that in the presentation. Can you just give us some insight as to what exactly that is when you speak of it?
Yeah, it's a great question. Coinbase is just a crypto brokerage. So just like a traditional stock brokerage helps you buy stocks, Coinbase is a company that helps you buy crypto. They're also a custodian, so they hold the crypto assets. I raised it a lot because it's a company that's about to go public in the US at an 80 or $90 billion valuation. So it's a giant, it's the largest single exchange for crypto in the US. And it has a retail app that's available through phones and makes it easy with a good user experience to buy a little bit of crypto.
All right, thanks for providing that clarification.
Yeah.
All right, Tivia Daly is asking, is there a possibility for Bitcoin miners to crash, and what will happen to your ownership then? So she's going back on the risk side of it.
Great question. If the internet failed globally forever, in other words, the internet went off and it never came back, your Bitcoin would not be worth anything, because it does require the existence of the internet for it to move or be verified. And without the internet, it wouldn't exist. So if you're like an apocalyptic, build yourself a stronghold, arm yourself with guns or whatever, because the world's going to end, Bitcoin is not a good solution. As long as the internet exists somewhere, the crypto mining, the Bitcoin ecosystem, the Bitcoin blockchain will continue to exist and be monitored and maintained and secure. So any individual miner, they crash all the time because they're computers, but there are hundreds of thousands of them around the world, and they're easily replaced. So you would need a really catastrophic event for it to go down, and it would need to never come back, or else they could restore from where it was in the past.
Okay, so another risk question here from Adam Cummings. How do we keep our crypto portfolio safe offline? Such
a great question. This is really important, so I hope everyone is paying attention. When you own a crypto asset, what you own is a password. And that password lets you unlock that crypto asset and send it to someone else. If someone steals your password, they've stolen your crypto. So it's not like a credit card, whereas if someone steals your credit card and goes to a nice dinner, your bank will reimburse you for that money because it was fraud. If someone steals your crypto, it's more like someone stealing cash out of your wallet. And once it's gone, it's gone. So you need a good way to store that password. The way we do it, because we do it at scale, we work with institutional custodians. This is all that they do. So they have elaborate systems for making sure these passwords are secured in a cold storage offline solution that's extremely secure. As an individual, most people will access crypto on their phones through apps. The big risk there is that someone steals your phone and breaks into it, or SIM hacks your phone and steals your identity and whiskers away your crypto. And so the way to prevent that is talk to your cellular provider about making sure you can't be SIM hacked and your money can't be stolen. But it's a great question. The best answer is work with an institutional custodian. The second best answer is be careful with the password yourself.
I think that was a great question, Adam. Thanks so much for that, because I think a lot of the time we take it for granted that what we have is safe. But if you're
100%.
investing your money, you need to keep it safe.
Yeah.
All right. So I think this is going to be our last question, Matt, and I think it's a good way to sum it up. I know that the aim of this wasn't to get Bitwise more clients, but I've been getting the questions. Can Jamaican retail investors become Bitwise clients? I know that there are some regulations and some FATCA.
Thank you for the questions. The short answer is yes. I mean, so you can email me, matt@bitwiseinvestments.com. I'll put that in the chat if you're interested. We have an offshore fund that's available to international investors. They're relatively high minimums, but I'm going to add my email there because I spelled it wrong. I apologize.
All right. While you're doing that, could you also put any social media handle that you have? Because I've also been getting that question in the chat.
Sure. There's matt@bitwiseinvestments.com. I'm at Matt_Hougan on Twitter, and I believe I'm Matt Hougan on LinkedIn. But you can find me. I put all those in there. I'd love for you to be a client. If you're interested, I'd be happy to share about the offshore fund. I'd also be happy to connect you with other funds that are interesting as well. But most importantly, I put that in there because the thing that I love to do is answer questions about crypto. So whether you're a Bitwise client or not, if you have a question about crypto and you want me to answer it, or you're interested in where you should look to read about it, reach out to me on email, on Twitter, on LinkedIn. I love those questions, and I promise I'll get back to you. And if I can't answer the question, I'll connect you with someone that can. My big role, and the reason I'm not focused overly on Bitwise's specific commercial products, is just to grow interest in the crypto ecosystem. And I think if that happens, Bitwise will do fine. So really do take that to heart. Not the email that has the misspelling, but the right email. Feel free to email me or Twitter me whenever you like.
Thank you so much, Matt. Oh my gosh, this has been such a good experience. And I mean, we've been seeing comments in the chat, awesome presentation, great present. So you did a great job, Matt. Not that I was expecting anything less.
Thank you so much.
This has been 2 years in the making. We've been talking about this for 2 years now. And I think we've had this discussion at the best time.
Definitely.
So as we wrap up, Matt, thank you so much for sharing your knowledge, your thoughts, your experience on this topic, for bringing to life a lot of the things that we read. As I said before, guys, a lot of the things that Matt showed us today is not available online. So feel free, go to our YouTube channel, go to the CFA Society Jamaica website, rewatch it. And you can rewatch it as many times as you need. All right, so we look forward to hearing more from you with the Bitwise, with ETF. Hopefully, whatsoever approval you need to get from SEC, you get that very soon.
Thank you. I hope they're listening.
Awesome. So we also would like to thank everyone for joining us today. Based on the survey, we had a lot of persons from Barbados, Cayman, Bahamas. I mean, the most persons are from Jamaica, but you have to expect that. We also have persons, I know we have persons from North America as well, persons from Canada. So it was very good to spend the evening with you, and want to also thank the CFA Society Board, the organizers of this event, for putting in a good job. And I think we did a great event today. Everybody seems to be excited. So Matt, I'm hoping that you can give us some more time probably later this year to come back again and probably talk to us more about the development in Bitcoin. I think we would really love that.
I would love to. Thank you so much.
No problem. So before everyone drops off, there is a survey that we want to take. So there are 75 participants as of now. I'm going to hold everybody accountable. I want to see 79 responses. I think we owe this to Matt. We're just asking for some quick feedback. Is just one question. Quick feedback on the webinar. So I'm going to ask Jan if she can just raise that now. So before you drop off, just tell us your thoughts.
You guys are making my day. It's beautiful. Thank you so much.
That's so awesome. All right, so Matt, so far 82% gave you a 5.
All right. I love it. I appreciate it, everyone. I appreciate all of you.
I think we're at 62. All right, we're making our way, 94%. Guys, thank you so much for this. All right, so we're at 97%, not seeing any more votes coming in, but 82% gave you a 5.
All right, I'll take it.
Right.
Thank you so
Awesome.
much.
All right, guys, thank you so much for joining us today, and we look forward to having Matt again, hopefully later this year. I'm talking it into being. All right, guys, have a great rest of the evening. Take care.
Bye-bye, everyone.